Hey, thank you for taking the time to click on today's video. Today, we are going to teach you how not to waste your whole life. Get it? Whole life? That's right. If I fail as a fiduciary and a financial advisor, I do not have any kind of backup career in comedy. Today, we're going to be talking about whole life insurance. And if you don't have one of these life insurance policies, that's fine. But if you do, this is something that could potentially save your whole life. Whole life insurance is one of the oldest forms of life insurance that exists in the world. And it's something that has worked very well with a lot of people, but today there is so many more variations of life insurance policies that we can own. You don't run into whole life policies very often, and when I do, they're typically very old. They're policies that have been around 20, 25, maybe 30 years or more. And it is amazing to me how limited the knowledge is about a person's whole life insurance policy. So today I'm going to give you a crash course so that you can get more from this policy and potentially save the policy and save some money to boot. So the first thing that we need to understand is that whole life is certainly a policy that has the ability of paying you dividends. And this is very, very important. What you're going to do with the dividends is going to influence the performance of the policy. But in addition to that, the way that the policy was originally designed, it was designed to pay your whole life. It was designed to pay to age 100 typically. Today I'm sure that there's whole life policies that you have to pay them beyond 100, but that is the traditional design. Now, unfortunately, there's a lot of people that have these policies. They knew that they had to pay for these policies their entire life. They had it in their mind when they bought it, and they still have it in their mind today. But they really don't need to be paying for this life insurance policy. They maybe don't even need the coverage that the policy is providing them, but yet they don't know what to do. They know that if they cash out the policy, they're going to lose the death benefit and they're going to pay a bunch in taxes on the interest that has accumulated in that policy. So what do? Well, the first thing is that if you wish to pay it to 100, you can do that. There's nothing that's going to prevent you from continuing to pay the premium. And if this is a really old policy, chances are the premiums are pretty inexpensive. But every penny counts in today's world. So one of the things that I run into all the time is that people do not realize that they can take their life insurance policy, their whole life policy, and they can invoke what is referred to as a reduced paid-up policy. Now what this is basically doing is you're going to the company and you're saying, listen, I've got a $100,000 death benefit on my policy, but you know what? I got $50,000 of cash. I want to take this reduced paid-up policy. What they're going to do is they're going to take the $50,000 of cash value in that whole life policy, and they're going to keep it in return for giving you a policy that is completely paid up. What this means is that, yes, you gave them $50,000, but in return, they're probably going to give you a policy that is now completely, totally paid up. You're not going to have to pay another single dime in premium, and guess what? It's going to be worth more than the $50,000 of cash. In other words, the policy was $100,000. You turn it into reduced paid up, you give them the 50 grand, you might end up with a policy that's got $75,000 worth of death benefit. And guess what? That death benefit is going to be guaranteed to age 100. So this is a way for you to get out from underneath the premiums of your policy, or just simply avoid the taxation, but yet still get something that's beneficial for your spouse or for your family. Now, when it comes to dividend options, this is also a huge thing with me. I never want a dividend wasted. And when I look at most life insurance policies today, most whole life policies that are paying a dividend, which is called a participating policy, most of the time I see this option right here, which is to buy what is called paid up additions. Now, what is a paid up addition? Well, every time the dividend gets paid by the company, they're going to, if they have a dividend option, a paid up addition, they're going to use that dividend to buy a paid up policy. Now, this is going to be a little policy. So let's say that you had a $500 dividend that gets paid to you for the year for owning this life insurance policy. If your dividend option is paid up additions, they're going to use that $500 and it might purchase for you a paid up $700 of additional death benefit. Now this is nice because what this means is that your original death benefit that you started with in this policy is not just going to stay the same. It's going to compound. It's going to get bigger. And the idea was that this is going to help to combat inflation. Now you need to be cognizant of what your dividend option is, because this is not a default. It's what I see most of the time, but it doesn't mean that that's what you have. So another option that you have with your dividends is to actually pay yourself. So what if you're in retirement and you need some additional income? Wouldn't it be nice? I hear so many people say, man, I really like my tax refund. I look forward to my tax refund. Well, what if your life insurance company just simply took that $500 dividend and paid it to you once a year? Wouldn't that be kind of a nice gift? Well, that's one of the options that you have with your whole life policy. You can call the company and say, hey, I wish to change my dividend option to pay me in cash. And guess what? They're going to send you the check. Does that mean your policy is going to grow? No. Your policy is not going to grow in death benefit because they're not using the death benefit to buy a paid up additional insurance. They are using the cash now and paying you that dividend so that you have the income instead. So just keep that in mind. Another thing is that you can have the dividend just simply sit and accumulate at interest. Now, interest rates typically in these older policies are pretty decent. You know, you might make 3%, 3.5%, 4%. I've seen some as high as 5%. Those are the really, really old policies. But guess what? If you want to accumulate cash in that policy, you can do so. You can have that dividend paid. Now, this is probably the least effective one that I can think of. I really don't see why a person needs to build up a ton of cash in their whole life insurance policy. But if the interest that you're getting on that dividend is really, really good, so be it. You can use that as an option. But this is the one that I want to talk about the most, and we'll close with this. Using your dividend to reduce your premiums. So let's say that you want that $100,000. You don't want $75,000, but you really need all of that death benefit, but yet you're struggling to pay the premium, or you simply are getting sick and tired of paying the premium. Instead of using the dividend to buy paid up additions, you can switch your dividend option to reduce the premiums. And what's going to happen is, let's say that you have a $500 premium that you're paying every single year in that policy, and you get paid a $500 dividend. Well, guess what? That dividend is now sufficient to cover 100% of that annual premium in that policy. Pretty cool stuff, right? Now the question becomes, do dividends grow? And yes, they do. Over the course of time, typically dividends get bigger and bigger for a person's policy as that policy ages. So what if you've got a premium on this whole life policy, it's $500, but your dividend is now $700. What's going to happen? Well, they're going to put a bit of a spin on this reduced premiums, and they're going to throw in a PUA. What's going to happen is they're going to use the $500 of that $700 dividend to pay the premium, and then they're going to use the excess $200 of that dividend to buy paid up additional insurance. It's like having your cake and eating it too. So I hope you've had an opportunity to learn a little something. If you have a whole life policy, remember, it's always a good practice to keep your policies up to date, making certain your beneficiaries are up to date, making certain that you've checked in on the health of the policy. You're working with someone that actually knows life insurance, and they can actually do an assessment on your policy to make certain that it's still cost effective, it's still doing everything that it's supposed to do. And if it's not, well, guess what? It could lead to problems before you pass, and you don't want to outlive your life insurance. You want your life insurance to outlive you. So again, thank you for this video. If you watch this video and you like it, give us a thumbs up. I appreciate that. Share this with your friends. If you have any friends that you think might have some whole life insurance and you want to save their life too, make certain that you hit the little subscribe button down here and the little bell, and we'll notify you each and every time we have a video. Thanks so much for watching. I'm Matthew Johnson, and remember, it's up to you to make today a great day.